Hi, my name is Kunal Khanna, and firstly, thank you to every investor who's actually shown trust in our AIF, made in AIF SBI Optimal Equity, and been invested with us over the last 1 year and a couple of months since we've actually started this first made in AIF of SBI Funds Management Limited. What we've tried to do here is we've tried to bring our CIO SBI Alternates Gaurav Mehta, and get a few questions that you might have in your mind regarding this AIF, and we'll try and over the next few minutes try and ask these questions to Gaurav Mehta from our perspective that try and answer whatever doubts that you would have in your mind for this particular product. So welcome Gaurav, welcome to this series that we're trying to do over every quarter, where we come in with a few questions that the investors will have in their mind and try and get your responses. But firstly, I think congratulations on completing 1 year in July this year, and I think the product has done phenomenally well over the last 1 year, right? But what is your belief? Because this particular product was conceived for investors who don't like too much of volatility, right? And if you talk about volatility, last 1 year is been everything about volatility, right? So first, we've actually seen a huge time correction. We've seen markets go to a lifetime high, and we've seen some bit of correction in the last few weeks. So how do you perceive this particular product has done well in the last 1 year? How do you perceive this product will do well over the next couple of years?
Right. So Kunal, if you think of the last 12-month period, I think you can easily divide it into two different phases. There was this period from June, July last year, all the way up to March of this year, when there was a lot of turbulence, there were a lot of challenges, and I think the markets broadly were sideways and they were quite choppy, right? They were going up and down and doing all sorts of things. And then March onwards, over the last 6 months, you've seen that it's been a decent market, even at the Nifty and the Sensex level, but it's been a much better market at the broader market level. And our approach in this product is to have an investor experience where they don't compromise too much on returns. They generate a long only kind return experience over a cycle. But at the same time, with respect to volatility, with respect to risk, they should be able to. And again, this is not something that I can sort of put in writing or vouch for, but our attempt is to at least mitigate volatility to the extent possible versus what you see on the indices, right? And if we achieve half of the indexes drawdown in a big market fall, then I think we would think that we've done our jobs. And over the last 12 months, we did see a period where somewhere towards late 2022, where the index was indeed down 10% from its previous high. And during that period, our portfolio, did fall by less than half of the index's fall. So to that extent, on the risk front, we did achieve what we thought we should achieve, even though 12 months is not that big a period to draw a lot of sort of episodes from and to draw a lot of learnings from. But still, whatever you saw, you did curtail the risk to the extent you thought you would. And then subsequently, as the markets recovered, we were able to recover as well. And again, one aspect of it is obviously the asset allocation piece, and on asset allocation we've been very conservative over the last 12 months because our asset allocation frameworks haven't asked us to swing very strongly towards equities, and to that extent our average asset allocation has been about 60-65%. The neutral asset allocation on this product is 70, although we can move from 0 to 130, but we've stayed even lower than that 70 over the last 12 odd months. But it's the stock selection piece that's really helped us and still sort of outperform the index even in a rising market. So I think this combination of stock selection and asset allocation is how we look at this product, and which hopefully should help us achieve that desired objective of long only life returns over a cycle, but with half of the indexes drawdown in big market falls.
So as you mentioned, the key forte of SBI Funds Management has been stock selection, has been the strong investment team that we've had at SBI, right? And I think 55% of our allocation in small caps. I don't think investors will have anything to complain with a 20% return on a 1 year basis. But again, Gaurav, you've been one of the few people in India who've been at least associated with long shorts as a strategy for a very long time, right? Now, there are two types of long short strategies in India. One is a debt plus kind of a long short strategy. One is the one which you're running in optimal equity, which is more like a Nifty plus 1%, 2% kind of a return. Now, from an investor perspective, can you just explain the difference, how both the strategies different and how do they operate in different time frames?
Right. So I think one is obviously the absolute return focus strategies where you're aiming to achieve whatever that return number is, 7, 8, 9%, irrespective of what's happening in the market. I think the challenge with that in the Indian context is that because the taxation is so high, you have to generate quite a lot more of gross returns to generate an eventual investor experience of 7, 8% net. And that's something that we've seen that not a lot of long short funds have been able to achieve.
So in the taxation, you mean 42.7% business tax that an investor will pay.
That's right. The other approach is to have a equity like product, but because there are added advantages in an AIF. For example, you can express your asset allocation much more flexibly, right? Because you can short Nifty futures, you can go beyond 100% in terms of your overall allocation, etc. You can still create risk rewards which are differentiated versus a conventional long only product without compromising on the end return, and which has been our objective here. Use that asset allocation framework, and again that framework basically at some points can ask you to go to 0% equity, and in other extremes it will ask you to go as much into equities as you can, and the maximum equity range that we've defined for this product is 130%. So we can move from 0 on the way down to 130 on the way up, with 70% being the neutral. But eventually, through this asset allocation and obviously the stock selection that comes along with, our endeavor is to achieve long only like returns over a cycle, but with half of the drawdown risk that comes along. And the way we've structured this product is very simple. We're thinking of 70% of the AUM as long only AUM, where we are buying 25 to 30 good quality stocks. Again, thinking of it as a core satellite combination where even your satellite stocks are held for 3-5 years, the core stocks are hopefully held for even longer. So that's 70% of the portfolio, and then you use the remaining 30% to leverage on either side through Nifty derivatives, so that if you want to come down to 0, you can create 70 short through Nifty derivatives. If you want to go up to 130, you can create 60 long through Nifty derivatives and complement this stock piece. So I think that combination is what we think will eventually help achieve this desired risk reward of long only like returns, but with half the associated drawdown risk.
Great. So very interesting. You try to explain how the asset allocation model will help us move from 0 to 130, during the investor's investment with us. But if you could just explain to our investors how this asset allocation model actually works. Have you done some backtesting? Because this optimal equity product that we have has been in existence only from July last year. So have you done some backtesting on this asset allocation model? How do you come to a conclusion when do you go to 0, when do you come to 130? If you could just explain for our investors.
Right. So I think the asset allocation framework is very simple. It comprises of 3 different pillars: valuations, earnings, and market sentiment. We know that valuation and earnings are 2 driving forces for price of any security. Market sentiment is something that we've quantified because we know that markets go through their own greed and fear cycles, and you logically should be a contrarian. So when fear is at a maximum, you should actually be a contrarian buyer, and similarly when greed is at a maximum, you should be a contrarian seller, because that's when you will get everything which is priced to perfection and so on. So to that extent, when a combination of these 3 pillars tells us that everything is, market valuations are expensive, sentiment is euphoric, earnings are toppish, that to us is an indication to cut down on equity exposure. Specifically for this AIF, what we've also done is to introduce a volatility state. It's a technical factor essentially that looks at market volatility. Typically in a risk-off phase, market volatility goes up, and in a normal market environment, volatility is usually more contained. So this model helps us take a view on whether volatility regime has changed to a high volatility stage. And once that happens, we take that as a signal that we are entering a risk-off phase, and we should now turn towards capital preservation rather than wealth generation, and which acts as a safety mechanism and brings in a degree of conservatism to this product. So I think that, very simply put, is the asset allocation framework. Yes, we have backtested it. You're right that last 12 months have not given as many opportunities for asset allocation to widely move from one extreme to the other. But let's say in an environment like 2008, and in fact when we started with this product, this is what we had thought that would be the best period. What is the best environment for such a product to work? If you fall significantly from an elevated valuation and high euphoric market level, then because your allocations are much lower than a typical long only product, you fall much lower, you generate that outperformance. And then on the other side, after a big fall, hopefully valuations are cheap, market sentiment is pessimistic, and that's when you actually could participate potentially with 130% upside, because we can go up to 130% on the higher side as well. And that period, right, where you fall less than the index through a fall and then rise much higher than the index because you're participating at 130% during the up move, is what should give a very good sort of investor experience. That hasn't happened over the last 12 months, but through our backtest, we do think that the model will do a decent job when such episodes of large falls and subsequent upticks arise. The last such episode would have happened, let's say, during COVID. It was a big 2020, a big fall, and after that fall, our valuations and sentiment measures did go to lower extremes, suggesting that we should be big contrarian buyers. And at that point, you could potentially have gone to 130% had the product been in existence. Hopefully you will see those market cycles as you move forward. Last 12 months, the asset allocation piece hasn't had to do much, but thankfully the stock selection piece worked, and that's helped the portfolio.
And very interesting. So again, I think from an investor perspective, that's the reason why SBI Funds Management has kept a 3-year exit load in this product, because we want the investor to come in, see the down cycle, see one up cycle, and I think over a 3 to 4 year period, you would see one of the down cycles, one of the up cycles, and hopefully we'll be able to maximize the returns for the client on the upside, minimize your returns on the downside. That would enhance the overall experience of the client. So I think that's a fantastic concept, very different from what you actually see in the market. So yeah, great job on that, on the performance of this fund over the last 1.5 year. But again, Gaurav, historically we've seen for HNI clients, mutual funds were always the option as far as investments is concerned. So whenever someone would take higher risk, would have gone to a small cap fund, and that's about it. But over the last couple of years, and especially post demonetization, where a lot of money is coming to the formal economy, AUMs of these funds have actually swollen up to a great extent, which is curtailed the ability of a fund manager to buy these small caps. So again, the choice of the HNIs today has actually been moving from mutual funds to alternates, and especially on the alternate side, Cat 3s have been the choice of an HNI client from a perspective, from a taxation perspective. But apart from the taxation perspective, Gaurav, what are the advantages that you have when you manage a Cat 3 AIF compared to a mutual fund or a PMS for that matter?
Right. I think one big advantage is size, because sizes are still small, as you rightly said, versus a conventional mutual fund where the ability to invest in a wide variety of stocks gets limited, because you can only buy stocks higher than a certain market cap or grade, which have a certain liquidity constraint. So that essentially restricts you to the top 300-400 stocks at max. Versus which your ability to play the broader market is much higher in a smaller size product like an AIF. But I think the other important difference is the fact that you can leverage, you can go short, so you can do all sorts of things in derivatives which you can't do in a conventional mutual fund, and that in turn allows you to offer very different risk reward characteristics versus a conventional mutual fund. I mean, theoretically you can customize a portfolio to the client's specific risk reward, although we don't do that in this product, but at some point, hopefully with the use of technology, that's the aspiration, that customize a product to the client's risk reward, and then accordingly mix both asset allocation and the stock selection pieces, so that it's very tailor made to that particular client's needs. But still, in an AIF you can create risk reward structures which are very different from a conventional mutual fund, simply because your ability to express that asset allocation through derivatives is much higher here versus in a conventional mutual fund. And the third aspect is obviously to do with fee and those things, right? Because everything is very watertight in a mutual fund. Here you can have different fee structures wherein you try and align the client interest with your own interest, and pay for performance and so on. So I think a lot of those factors, when you combine them, give you a very solid proposition versus a conventional fund. But and again, globally, if you see, that's been the trend, that alternatives as a piece of overall client AUMs has only been increasing. The bread and butter could still be your conventional product, but having an alternative product like a PMS or a long-short AIF will obviously help you better sort of customize your risk reward. And the last point that I want to make on that, because we also run two PMS strategies, we also run this long-short AIF, is that when I think of risk reward, there's a certain risk and a certain reward that a conventional mutual fund offers. In the PMS, our endeavor is that without taking much extra risk, can you enhance returns versus a conventional mutual fund? That in turn increases or improves the risk reward for the client. It becomes a more aggressive product, but improves the risk reward. Versus which in the long short AIF, our endeavor is that while we don't want to necessarily outperform a conventional long only product on returns, but on the risk front, our hope and our endeavor is to be closer to half of the risk of a conventional fund. And again, in that way, you are sort of trying to enhance the risk reward for the client, although in this case you're becoming more conservative, but essentially still trying to have a risk reward which is better than a conventional fund. So I think that's how we're thinking of our alternatives for positions versus a conventional mutual fund.
But again, Gaurav, although we've been trying to do a very good job on the stock selection side, the asset allocation model plays itself very well. And as you said, size is at our advantage as far as the alternate piece is concerned. We are a new entrant into the market, so we're gradually moving towards an established player as far as the alternate business is concerned. But is there any way in an AIF, and especially in the Cat 3 AIF, because from a taxation perspective, it's a fantastic product for an HNI client because the entire hassle comes on us. So whatever taxation is paid by us, and whenever the client gets the money, is post-tax money. But is there something in the AIF that we can do, on the IPO side? Because there have been some good IPOs that have been coming up, and SBI selectively has been investing on the mutual fund side, in certain IPOs. Is there something that we try and do on the AIF as well?
Right. So I think IPOs is one interesting pocket where there is scope theoretically for price inefficiency, right? So that I won't use the word price inefficiency, but the IPO process itself is a process of price discovery. It can work both ways. You can have IPOs which are way overpriced than they ought to be, and you can have IPOs which are way underpriced than they ought to be. And which is, that's with the excitement of investing in IPOs, that you get to participate in that price discovery process. And to that extent, I think an AIF does, is a platform where you can exploit that benefit. And yes, we have, over the last few months participated in quite a few IPO opportunities. And it can either be through the anchor investment route or through the pre-IPO route. But yes, that's something that, and unfortunately, you can't do that in a PMS. You do that in a mutual fund, but again, because of size constraints, the ability to have a significant attribution through a single IPO is limited. So I think from that point of view, there is that advantage that AIFs have, where you can still invest in pre-IPO or anchor opportunities and have a decent attribution as well. That said, we're very selective with respect to evaluating IPOs, and for us, IPOs are never a flip. A lot of people do that. We don't do that. Our endeavor is that are we getting into businesses where we ideally want to hold them for the long run, but because of that price discovery process, hopefully we're getting some bargains there. So that makes it a win-win. You're getting a good business at a good price, and that's something that we want to exploit through the IPO route.
So that's really fantastic. And what we tried to do here is the last few questions that I've asked Gaurav, just try and give his magic recipe that he's trying to use as far as managing this particular AIF is concerned. And one promise that we would like to make is we'll try and do more of such series over the next few quarters, so that you get an update on what is happening on the AIF, what is happening, what is Gaurav doing with your money, and how do we position this product over the next few years. This is a commitment that you've done with SBI Fund Management with a 3 to 4 year kind of a view, and hope you would be happy investors at the end of it. Thank you so much for joining me. Thank you.
Thank you.